Welcome everyone to Self-Managed Super Fund and Investment Property webinar. So a little bit about myself. So my name is Bimal Sekhon. I'm a chartered accountant and I run Auto SMSF. So Auto SMSF is an accounting firm just specialized in self-managed super fund, and we cater clients all over Australia. So we are based in Melbourne, but we've got clients all over Australia. So just before we start, a disclaimer, we are not a financial planner. Auto SMSF is not a financial planner. We are just an accounting firm. Any information we are sharing today is just general information. It's not personalized. So, but if you need any advice, please contact us. We can direct to your financial planner or just contact your financial advisor for that. What we're going to cover today. So in our webinar today, we're going to cover what is self-managed super fund, how a self-managed super fund is different from other super funds, what we can actually invest in self-managed super fund, and then we're going to concentrate mainly on the property investment in self-managed super fund, how we can actually use borrowing or leverage to in a self-managed super fund, and actually the tax benefits of the super fund. Let's start with self-managed super fund. So self-managed super fund is actually a type of super fund where members run the super fund for their own benefit. So it's not run by any other company or anyone. It's actually the members who run the super fund. The whole purpose of self-managed super fund or SMSF is for retirement. So anything that you do, all the investments, everything are actually for your retirement. And whatever a trustee do, they actually do in the best interest of members. You can have up to 6 members in a self-managed super fund, so which means that you, your partner, your children, your siblings can actually combine your super together in a self-managed super fund. So, but whether it's a good idea, let's just discuss with your accountant or your financial advisor about that. You can actually roll over your super from your industry fund or retail funds into self-managed super fund and use that money to actually invest. Now, this is not an early access to your super. A lot of time you can see a lot of schemes where actually people say, you set up a self-managed super fund so you can actually use that money now instead of waiting for your retirement. Self-managed super fund is not for that. So just be clear, it's not early access to the super. And the other type of super funds. So as you are aware of, like there are industry super fund, there are retail super fund, there are employer super fund, defined benefit super fund, and self-managed super fund. The main difference between the other super funds and self-managed super fund is this: in self-managed super fund, it's the members who are the trustee or the directors of the trustee company as well. They are the one who manage the super fund. Whereas in other super funds, it's the trustees of that super fund manage for all the members. So both those are more like, if you say, it's a public company, whereas self-managed super fund is like a private company. I'm just trying to tell you the difference. Now, in self-managed super fund, the control is in members or trustees' hands, and as the control, the responsibilities are of members and trustees as well. So whatever you decide, it's your responsibility. Now, members and trustees, they decide where to invest, so they can choose what type of investments they want, where to invest, how to invest, when to invest. The whole decision is in the hands of members. And obviously in self-managed super fund is the only super fund where you can invest almost everywhere. So there are a lot of investments available in compared to any industry or retail super fund. Now, where and what type of investments are available in self-managed super fund? So there are cash or term deposits. You can invest in just normal cash and term deposit. You can buy shares in Australia, outside Australia, in overseas markets. You can buy ETFs. You can actually invest in managed fund. You can buy crypto, gold, silver, platinum, any of those precious metals. You can actually invest in paintings, vintage cars, jewelry as well. And most importantly, yes, you can buy property, whether residential or commercial, in self-managed super fund. And there are many more investments. As long as you stay with the rules, you follow the SIS or self-managed super fund rules, you can invest almost in any type of investment. Now let's talk about property investment. So in this seminar, we are mainly focusing on the property investment in self-managed super fund. If you want to talk about or want to know about any other type of investments, we can discuss that separately. So out of all the super funds that I mentioned earlier, it's only self-managed super fund that allows you to invest directly into the property. You can do indirect investments in other super funds, but in self-managed super fund, you can actually go and buy the investment. You can buy any type of property. So you can buy commercial, residential, townhouse, apartment, any type of property you can buy in self-managed super fund. You can actually also invest in land only. So you can just buy the land only without the building on it. You can go for home and land package, provided that is under one contract if you are borrowing against it. So saying that you can't actually buy land and build on it if it's with the loan. So if you're using the borrowing for that one, so that's the restriction there. Now, the question how actually we can buy in self-managed super fund. You can buy directly without going for loans. So you've got, so say for example, you and your partner both got 400,000 in super, you combined your super and you can go and just buy a property outright for 700,000. So no loan, and it's simple. The second option is you can actually do additional contributions, either concessional or non-concessional. So say, for example, you're looking for 500,000 worth of property. You only got 400,000 in your super and you are short of 100,000, but you've got this 100,000 sitting outside the super environment. You can actually then put this money as a contribution in your self-managed super fund, provided you are under the limit. And now you've got 500,000. You can actually invest that in self-managed in a property. It's one way. So that money is gone into super fund as a contribution. You can't take it out. So that's, you need to be careful when you make these type of decisions. And the third option is with the loan or borrowings, and we call it limited recourse borrowing arrangement, or short form LRBA. You may have read or heard this word a lot of times. Now, let's talk about what is limited recourse borrowing. And this is the most popular way of actually investing in self-managed super fund nowadays. So limited recourse borrowing arrangement is actually getting a loan against the property that you are buying in a self-managed super fund. Now, this is not same as buying your owner-occupied house or buying an investment property under your personal name. It is different from that one. So limited recourse borrowing, the word comes from, as it says, limited recourse. So when you're buying a property in self-managed super fund, you need to set up another trust called bear trust. This is the trust who actually holds the property, and the loan is against this property. Now, why it is called limited recourse? Because if anything goes wrong with this property and you are, or super fund is not actually capable of paying the loan, bank can only recourse this property. So if you got, say, 1 million in your super fund in shares, the bank can't come and touch those shares to actually cover up the loss. Saying that when you're actually going for any loan, you are doing the personal guarantee, so bank is covered. They can always come after you personally, but they can't touch the other assets of the super fund, and that's the reason why it's called limited recourse borrowing arrangement. The whole reason for doing that one is to actually protect your other assets. The question is this only available for properties? And the answer is no. The limited recourse borrowing arrangement can be used for any type of investments, but because it's so complex, you have to actually go through, firstly, not all investment types offer this one. And secondly, you have to go to some financial advisors to look for those products. But for the properties, it's very common. A lot of people knows about it, and it's very easy to get the loan for the property under the limited recourse borrowing arrangement. Now, the question a lot of time people ask, why to actually get a loan to buy the property in super fund? Why we just wait and just get the money in and then buy the property outright? I'll explain that one with a small example. So this is my small worksheet. Now, this is just a rough idea. I haven't taken into account a lot of things like inflation and all those. So let's take an example. So we've got a cash contribution. So we've got a cash sitting in super or with you 100,000. So we can either invest that 100,000. Now I'm taking any type of investment, whether it's a share or property, and assuming that all investments are going to grow at 10%. So we are comparing apple with apple. So if we are investing this 100,000, in year one, we're going to get a growth of around 10,471 at 10% return, cumulative growth. If we got this 100,000 and we go to the bank and we say that we're going to buy an asset of 500,000, here's my 100,000, can you give me a loan of 400,000? Bank gives you this loan, and now you got an asset of 500,000 with this 100,000 cash contribution. Your asset in year one is going to grow to 552 approximately, but obviously you're going to pay the interest and the principal. I'm taking 6% average interest rate here because usually home loans are around 10%, superfund loans are always higher. So currently actually they are around above 7%, but on average, let's say 6%. So in year one, you pay interest and principal, plus you've got outstanding balance as well. So your net growth is 28,000. So you can see it's nearly double in first year. Fast forward, look at the year 25. You've got 1.1 million growth with 100,000 of investment, but you've got now around 5.5 million growth, which is nearly 5 times with a loan and borrowing. And reason for that one is you're increasing your return, or you're getting a return on a 500,000 investment compared to 100,000. So your investment is going up and your loan is going down. And that's the reason why borrowing always or leverage always gives you the better result. So as the SMSF is the same, so if you get that loan in SMSF, you can actually make your retirement fund 5 times more compared to what it is without the loan. Now, most of the time people ask the question, okay, that's good, we can invest in the super fund. Are there any restrictions? Yes, there are. There are restrictions when you are actually buying a property in self-managed super fund. So the first one is, as I mentioned earlier, you can't buy a house and land package if it's under a separate contract. It needs to be under one contract because under the limited recourse borrowing arrangement, it needs to be a single asset. And if it's a house and land separately, it's considered as a two separate assets. You or your members or the related parties can't actually live in that residential property. When we say related parties, it's not just your relatives or your siblings. Related parties covers more than that. So your business partners, your employee-employee relationship, they are also related to you. So if you buy a property in self-managed super fund, you can't live in it. Your family members or your related people related to you can't live in it. So, and your business partners or their relatives can't. So anyone that's associated to you under the definition of related parties can't actually live in that property. Now, often, of course, people ask, what if the arrangement is through a real estate agent, we are paying the market rent? Even then, it's not allowed. So you can't actually do, and the fines and the penalties are very high if you do that. But if the property is commercial property, then actually you can rent it to your business. So that's the exception here. The most importantly, the big difference is if the property is in your self-managed super fund, you actually can't use any of the rental income or capital gains made from that property for your personal expenses before the retirement. So say if you are 50 and you sold this property, you made the profit on that one and you want to use that one to go on holidays, no, you can't do that one. You can do that if you are retired. So if you're over 67 and your fund is in pension, you can do that. But before that, you can't do. But you can actually use that fund to buy another investment in self-managed super fund. So the restriction is you can't use personally. So you can't use that money to buy personal assets, or you can't use that money to spend on your personal expenses. Now, the most big important one, the tax benefits on self-managed super fund or any super. Now, as everyone aware of, the income in self-managed super fund is actually taxed at 15%, or in any super environment is taxed at 15%. Capital gain made on any investment is at 10% if it's more than 12 months. So if we take into account the 50 discount, then actual tax comes around 10%. The best part is when actually fund is in pension phase, which means when you're retired and the fund went to the pension phase, all this income and capital gain is taxed at 0%. So there's no tax on in the retirement phase. There are some exceptions to that, but that's for the high income earners. So there are some slightly higher tax when you are earning higher or when you are above some threshold. So which goes up to 30%. But if you want to talk about that, yeah, I can explain separately. Now let's take an example to see how the tax benefit works in a super fund. So say you sold a property and made a capital gain of 500,000. Now, if this was under your personal name, you would have paid 47% marginal tax because it's a 500,000. After taking into discount, it's 117,000 tax that you're going to pay. If this property was in self-managed super fund, you would actually paid only 15% tax. After discount, it was 50,000 in tax. So compare the benefit. 67,500 is in your pocket instead of paying that to the tax office. That's the gain. Now, to make it even better, if this property was sold in retirement phase or in pension phase, then once you retire, the whole 117,000 is in your hands instead of going to the tax office. That's the difference. And you can use that 117,000 to sit on a beach like these two people in the picture. So now we know, yes, property is very good. It can give you a lot of benefits. It can give you tax benefits. Why? What's the difference between buying property in self-managed super fund versus outside self-managed super fund? So let's go with pros and cons. So if the property is in self-managed super fund, you can only pay 15% tax. You can only pay 10% tax on capital gains. So that's the big benefit of that one. You can actually sell this property and use that capital gains and invest in other assets. And same thing applies to other assets as well. Any income 15%, any capital gain 10%. Now, if it's in retirement phase, no tax to pay at all. And that's the big benefit because you don't want to pay any tax when you are retired. So that's a big benefit if you're looking for the retirement and if you're buying those assets for your retirement, super fund or SMSF is the way. If it's a commercial property, you can actually rent it back to your business and you can take even further tax advantages by doing that. Now, what are the disadvantages or cons? So firstly, you can't use that rental income to live on before your retirement. So if you want to use that rental income to offset your current income, unfortunately, you can't do if it's in self-managed super fund. You actually can't refinance the property and use the equity to buy another property like we do when we buy under personal name. So self-managed super fund doesn't allow that one. That's one of the big drawbacks. You cannot, as I mentioned earlier, you cannot live in it and you can't rent it to the related party. And the other one is you can't actually do the renovations if the property is under limited recourse borrowing. So if you plan to buy a property which is run down and you want to actually do the renovations and sell that to make a gain, you can't do that one in self-managed super fund if it's via limited recourse borrowing. If there's no loan involved, no issue, you can actually do that. It's just with the limited recourse borrowing arrangement. Now, things you should consider before actually you decide whether you want to set up a self-managed super fund or you want to buy the property in a self-managed super fund. I don't want to scare you, but it's just few extra things. Not hard, just like setting up your another company if you have or business. With self-managed super fund, there's a running cost involved, so you need to keep that one in mind. It requires some time and knowledge. And always your accountant, your financial advisor, or professional people are always there to help you with those type of things. Now, buying a property in self-managed super fund is expensive compared to buying under individual name, just because you need to set up the bare trust. Interest rates are slightly higher compared to when you're buying personally. Now, you as a trustee, you take the responsibility of everything. As I say, there are always professionals there who can help you with that one, because these all costs are minimal compared to the tax savings and other savings that you can actually have there. So, but I always recommend to actually, if you're not sure about that one, always speak to a professional or a financial advisor to know whether the self-managed super fund is a good option for you. So that's about the self-managed super fund. So, yep, if you have any questions, just put that in the Q&A, and I will now hand over to Danny to actually go over his part of the presentation.